The views presented today are provided by the AMAC Foundation Social Security Advisors, certified by the National Social Security Association, LLC. They do not necessarily represent the views of the Social Security Administration. The information presented today does not constitute financial, legal, or tax advice and should be used for informational purposes only. Since individual circumstances vary, you should consult your legal, tax, or financial advisors before making any financial decisions. AMAC Foundation is not affiliated with or endorsed by the Social Security Administration or any governmental agency. We're happy to have you back with us. A quick recap of what we talked about last week. We talked about benefits for children, benefits for adult disabled children, adopted children, stepchildren, benefits for parents that are dependent on a child. And we talked a lot about disability, and we talked a lot about this thing called family maximums and how that tends to cap benefits in some situations. There was a lot of material last week. And as I mentioned before, all of these sessions are being recorded and are installed on our foundation website. You can get them at amacfoundation.org/audio. Just go to that page and click on Social Security, and you'll see the first three recordings, the recordings of the first three parts of this webinar. So with that, we're going to get into part 4. Part 4 is going to be a discussion of the magical, got to think the right way to say this, the always interesting provisions of the Social Security law that are called windfall elimination provision, also known as WEP, and the government pension offset, which is GPO. So we're going to talk about what they are and how they affect benefits for certain classes of people. And then we're going to get into the taxation of benefits issue, which is something that, you know, we get a lot of questions about here at the advisory service from people that are unpleasantly surprised when they file their income tax return in their first year after retiring and find out that their benefits can in fact be taxed federal income tax. So that's a very unpleasant surprise for a lot of people. So we'll talk about that. And then we'll cover some cleanup items, the special lump sum death benefit, exactly what that is and how you access it. We'll talk about situations where people are receiving Social Security benefits but are living offshore and how all that works. And we'll close out with a discussion on some Medicare issues, particularly the hold harmless provision and this thing called IRMAA, income related monthly adjustment amount. Correct? Is that correct, Sharon?
Medicare.
Yes, you got it today.
Okay. Anyway, that'll be the wrap up piece. So with that, let's get into it. And what I'm going to do at this point, as I normally do, is turn it over to the experts. The experts being, of course, Eileen and Sharon. And I want to make a special note that we have another expert with us today. Russ Glore is with us. Russ Glore is one of our Social Security advisors. And you may have, if you looked at our websites or looked at any of our published materials, you'll see the thing called the Ask Rusty series. Well, Rusty is actually Russ. And he's with us today, and he may be interjecting some comments along the way. So with that, I'm going to turn it over to, I suppose, Sharon's first.
I believe Eileen has some statistics of what's going on.
This, something to, me, I just throw these things in.
Okay, well, either way, I'm backing out of the audio picture momentarily.
That's okay. So,
ladies, take it away.
This thing called the windfall elimination provision, or WEP, or we kindly call it WEEP, because it usually makes us weep. In December of 2020, about 1.9 million people, or 3% of all the Social Security beneficiaries, were affected by WEP. So just to give you an idea of how this affects 3% of the population. So they are a very, very vocal 3% of the population of Social Security recipients, and we'll leave it at that. So as you can see in the slide, it's applicable to those who have worked in areas not subject to Social Security withholding. Usually those are certain government employees, some teachers, municipalities, and all workers in that. It can cause the benefits to show on your SS statement to be reduced if you have less than 30 years of substantial earnings. Now, we're going to get into what substantial earnings is in a couple of slides. So another thing is it can affect your benefit. It can affect your spouse's benefit and other dependents' benefit. However, it doesn't impact your survivor benefits, but that's for another slide as well. We won't go there. So next slide. So my favorite thing, Sharon, this is your area.
However,
Take it away.
what actually happens when someone is subject to WEP is it results in a recalculation of your PIA. For those that don't remember what your PIA is, it's your primary insurance amount, which is usually equivalent to your full retirement age benefit. And as a result, all the benefits based on your PIA will also be reduced except for survivor benefits. The WEP reduction will be reduced for substantial earnings of more than 20 years and eliminate it completely with 30 or more years of earnings.
And I think the key question, as it was in that slide, in this slide, is substantial earnings. Correct, Sharon?
I will be explaining how so many people get blindsided because they work part-time jobs. So they pay into Social Security thinking they won't be subject to WEP. But there is a chart of how much you have to earn each year for them to be considered substantial earnings to count towards the 30 years or more to be
to eliminate the WEP reduction.
Right, correct.
Yeah. Next slide. Next slide. So, Sharon, if you can walk us through this, because I did not realize that the lump sum distribution also, and how they do that, because some people say, well, I'll just take a lump sum and eliminate the whole thing.
Oh, yes. A lot of people think they can just take a lump sum distribution when they retire from non-covered employment, and that will get them out of the WEP reduction. It doesn't work that way. Social Security will take the amount of your lump sum distribution, and they will determine what your monthly payment should be and how long that payment should last. If by any chance you outlive their calculations, the WEP reduction will go away and they will restore your full PIA, which means you'll no longer be subject to WEP at that time. One of the ways you can avoid the WEP reduction is you can forfeit your right to the government pension. That means you give up your government pension and only withdraw what you paid into it and interest earned on what you actually paid into it.
That's going to happen. So
Okay.
I was going to say, if you can see by the slide, it's a WEP state-by-step breakdown. There are 15 states where teachers do not pay into Social Security taxes and are affected by WEP and GPO. We will get into GPO once we finish up with WEP. So just a list of, however, there are some states, as they're asterisk, you can see that some teachers actually pay into Social Security, correct? And do not pay into that they forego or don't, I don't even know what you can call it.
It means,
go ahead.
There's some states that in one county you may pay into Social Security, in another county you don't pay into Social Security.
Mm-hmm.
And some states that teachers do completely pay in, where it's just the government workers, police, firemen, county workers.
Yeah. So, and these are the 20, another slide that shows the 27 states where county, municipal, and special district employees are affected by WEP and GPO. So there's a lot of them, actually. I'm
Yeah,
surprised that they haven't moved.
but
away
as
from that.
time's going by, it's becoming more and more common. A lot of these states have blended districts. California really surprised me with all the districts in California that now pay into Social Security
Yeah,
because they were always never paid in. But as time goes by, Texas, California, the only one I'm not aware of having mixed earnings is Massachusetts. Otherwise, they're pretty blended nowadays,
Mm.
as more employees have opted into the Social Security system.
And then as we can see down the road, that's going to be an interesting way to calculate the years that they did pay into Social Security and the years they did not pay into Social Security.
Correct.
So in the future slides, we'll go
A
into
little
that.
more interesting when you're dealing with what they call mixed earnings.
Yeah, so,
This is because of the complications of WEP and GPO. This is where we typically say if you are affected by either one of these, just give us a call.
Yeah.
And it'll take some analytical work to get to the details.
yes.
And
Thanks,
unfortunately, a lot of mistakes are made
Yeah.
that you wind up having to get corrected with Social Security. It's not uncommon. There was only one Social Security office in the United States that deals with WEP.
And
Yeah,
isn't
they-
it hand calculated too, Sharon? Don't they have to hand calculate it?
Well, they have never been able, like when you get your earnings statement, it doesn't account for WEP. It will just show your earnings and zeros because you didn't pay into Social Security. And
Mhm.
unfortunately, that estimate they're showing on your statement is incorrect because they have not been able to account for the WEP reduction when calculating your benefits. So you don't see it.
I would, this is Russ, I would just interject also that the Social Security Administration does have calculators which can give you an estimate of what your benefit would look like with the WEP reduction. You need to provide them with a certain amount of information, but at least it's a way to get at least an estimate of what the WEP reduction will be.
Yeah, and those are available on the Social Security website, ssa.gov. They are free. You will need your earnings statement and you can get an idea of what your WEP reduction will be.
So this slide, as you can see, is, if you remember how we did the PIA in the beginning, in the first. Now you're going to see the 2021 bend points, and that's important. So you see the 40% of the first 996 versus 90%. The 90% if you didn't have, government earnings. So the 40% is what is where a lot of people get messed up when they try to do it on their own.
Yeah, they think their benefits being reduced by 50% when actually it's not. It's that first bend point is being reduced. The second and third bend point aren't affected whatsoever.
Yeah, it's just the first one.
Correct. And anyone interested in knowing why, the government's reasoning for doing this is because Social Security is a weighted formula. It's weighted to give low income earners a higher return on their earnings and to give higher income earners a lower return.
Yes. So,
and there's the chart that's created strictly for employees subject to WEP. You take your earnings statement and you take this chart of substantial earnings and you compare them to your earnings for each year that you paid in the Social Security, and that will show you exactly how many years of substantial earnings you have. and whether or not you're going to be subject to WEP when you finally take your Social Security benefits.
Correct. Now, the other side of the coin, so to speak, government pension offset.
Now, this seems really easy, but it can actually wind up being more complicated than WEP at times. Now, the government pension offset is harsher than the WEP reduction. WEP can never reduce your benefit to zero. The government pension offset, known as GPO, can actually reduce your benefit to zero, can zero it right out. It affects spouses, widows, and widowers. If you receive retirement or disability benefits from non-Social Security covered employment, benefits will be reduced. 2/3 of your government pension will be deducted from your spouse's, widow's, or widow's benefit.
In the next slide, we'll give you a short example.
Yeah. Like take, for example, a spouse is receiving a civil service pension of $600 and is eligible for a $500 spousal benefit. 2/3 is $400 of their pension will be deducted from the spousal benefit, resulting in a spousal benefit of $100. If the reduction is more than the spousal benefit, the amount would actually be reduced to zero, and you wouldn't receive a spousal or survivor benefit on your spouse.
And
Once again, if you take a lump sum payment from civil service, Social Security is going to calculate the monthly equivalent and use that as the deduction amount.
Just a parenthetical comment, I guess from my observation, is that GPO almost always eliminates the spousal benefit and most often eliminates the survivor benefit.
Yes, unless they have an awful small pension, it usually does take those benefits away. Now, there are ways to avoid the GPO. You can work your last 5 years in a position that also pays into Social Security, but you have to work 0 days in a non-Social Security covered position. What this means is if you work 1 day in a position that doesn't pay into Social Security, that month won't count. So you have to be really careful, especially like with teachers. They'll get asked to sub, and then they do a substitute position to find out they didn't pay into Social Security that month. They have to work an extra month to make those 60 months.
so it doesn't have to be 60 months consecutively. Let's say you, like you said, a substitute teacher somehow does a day in a county that does not pay into Social Security. It doesn't mean it automatically resets. It just means that month will not count toward the 60 months, correct?
Right. You just have to make that 60 months in a position that doesn't pay into Social Security.
Okay.
So if you mess up and you work a day and one that doesn't, even if you work the other, say 20 other days that paid in, that month isn't going to count.
Thanks.
And if you already retired from your position and want to get out of GPO, you have to actually give up your pension by returning to work. You only have to work as much as 1 day per month for 60 months, 5 years, but you cannot receive your pension during that time. But during the time you don't receive your pension, say you're eligible for a spousal benefit on your spouse's record, you can collect the full spousal benefit during the period that you're not collecting your pension. So
Oh,
before you give that pension up, if you're at an age where you can get that spousal benefit, it might be worth it to you.
So
to-
it won't affect, you're saying it won't affect their spousal benefit? If you
Not
get
if
it,
you're
okay.
working and not collecting your pension.
You also have to notify,
Not collecting your pension, you're not subject to weapon GPO.
okay. But you have to notify, it's not like an auto, you have to notify them that you no longer, your pension, you put it on hold
Well,
for.
yes, I would strongly recommend notifying Social Security versus them waiting for them to get your
Yeah.
tax return.
Okay. Now, this is
Okay,
very-
and there is another way to reduce the GPO impact. And this one, a lot of people are not aware of it. Once again, it really seems to affect teachers that live in states where some counties pay in and some counties don't pay in. And these teachers move into another county. So they might have worked 10 years not paying in and 20 years paying in, or vice versa.
Mhm.
But when you do have mixed earnings like that, and it falls on you to get this proof to Social Security,
Mhm.
when you get ready to retire, you have to get a statement from your employer. They say it's easier to get it from your employer than the pension company.
Mhm.
That will show how many months you paid into Social Security and how many months they don't. Because then they will only base the GPO on the portion of your pension that you didn't pay in to Social Security. And these rules are not the same as the 60-month rule. These can be blended over your entire career. If you did 30 years teaching and you bounced around in between counties, paying in and not paying in, it doesn't matter. It's the total months you paid in versus the total months you didn't pay in that determine how much your spousal or survivor benefit will be reduced.
I have a friend who follows her husband, and she first started out as a teacher in New York. He got transferred to his job in California, so she was a teacher in the San Francisco area. Then he got transferred to the Texas office, and she became a teacher in Texas. And now he got transferred to the Florida office, and now she's a teacher in Florida. So,
Well, okay, let me specify. This must be the same pension plan.
it probably is. I'm not sure, but
If you switch pension plan, each one's going to be determined individually.
oh,
So
okay.
teacher in Texas that they seem to really jump around.
Yeah.
That's all that's the TRS. California, they're starting to do the same thing, but it's all the same pension plan. When you're switching states, you
Yeah.
might actually be switching pension plans.
Mhm.
So if you got one pension plan that you totally didn't pay in, that's going to be totally subject to GPO. If you worked in a state that you have mixed earnings, that's going to be based on that.
So that's,
Yeah,
she's facing a mess down the road.
right. And it's your responsibility to prove this to Social Security. They're not going to get that information for you. You have to get it and give it to them.
Okay. I'll give her that advice when she gets ready to retire, finally. So, like I said,
So Sharon, the takeaway is that it's up to you to find out how much of your pension
mhm.
is not covered and therefore subjected to GPO.
Correct. You have to get the paperwork that states the employee worked this many months paying in the Social Security, employee worked this many months not paying in the Social Security. It is your responsibility to get that information and submit it to Social Security. Without it, they will subject you to the full government pension offset.
That's a good thing. Keep all your paperwork, guys. Keep it with your taxes.
Very important thing to ask for when you're getting ready to retire if you're in this situation.
Yeah.
It's always easier to take it with you than to go back and try to get it later.
Correct, yes.
So you can see why, with these rules and the depth of these rules, you can see why the service that we provide becomes important to people that are retiring in these situations, because we do help them walk through this and understand what the rules are and what information they need to provide. It gets very detailed. So
I might add that these two particular rules, among the 2,728 total Social Security rules, these two are the most reviled rules of all.
yep.
One of them, yes.
Yeah, people tend to get a little upset with them.
That's
And they're you want to watch your payments from the get-go, because if you realize your payment isn't right when you start your Social Security, make sure you get it taken care of as soon as possible. It's also one of the hardest mistakes to get corrected with Social Security. And we've helped people through that too.
Yeah. Oh, I can believe that. It's very confusing. I can just imagine. Even the average Social Security advisor in Social Security Administration may have had the same issue.
Incidentally, I would also note that there is legislation that has been introduced in Congress to streamline weapon GPO, perhaps eliminating weapon GPO, or at least minimizing the impact. I don't know how successful that legislation is going to be, but and that was introduced in the last Congress and has not yet been reintroduced in the 117th Congress. So.
Right, but it's been that type of legislation has been introduced in every Congress for at least the last 5 years.
Yeah.
And it never really seems to get far beyond committee.
Yeah.
Being referred to a committee. So I don't
Yeah.
want anyone to hold their
Don't
up that
don't hold
it's
your
gonna
breath.
go
Don't hold your
away.
breath. Yeah.
It's not going to go away soon.
Yeah, AMAC has voiced its support for not necessarily eliminating, but perhaps minimizing the impact of weapon GPO. But again, as Russ just said, the odds of it getting through Congress are pretty slim. So
Yes, it is.
okay, moving on to the happy subject of taxation of Social Security benefits, and we get hit with this at our advisory service frequently. People that are surprised at this, that we're not aware that their Social Security benefit is taxed. I want to read something to you in an article that's going to be in the upcoming AMAC magazine. The IRS website offers this ominous warning. Don't forget, Social Security benefits may be taxable. Now, the problem with that is that's on the IRS website, not on the Social Security website. And so people are still surprised, and it becomes a pretty unpleasant surprise when they do their income tax return the year after they retired and find out that, whoa,
Yeah.
Social Security benefits are taxed.
And that tax can get pretty substantial depending on your other income.
Yeah.
Correct. Yeah.
Yeah, so let's talk through how that actually works. So go ahead, Sharon, take it away.
Okay, taxation of Social Security benefits. This is another area that everyone's very unhappy about. If Social Security benefits are your only income, they're generally not subject to tax. Confirm with a tax advisor. But when you have other income, pensions, wages from employment, interest, etc., your benefits are likely to be subject to taxation. It depends on the modified adjusted gross income for your filing status. When you look at your tax return, you see your AGI, your adjusted gross income, but there are a lot of things that affect your modified that the IRS will add back in.
Correct. Yeah. So you're going to walk us through how to figure out our modified adjusted gross income, Sharon?
Sure. Okay, when you want to determine your modified adjusted gross income, you take your wages, pensions, interest, self-employment. There's a whole list, and it also includes items that may have been eliminated from your adjusted gross income for federal tax purposes. So these items must all be added back into your modified adjusted gross income for the Social Security tax calculation. And I'll show you what those are on the next page.
An example of something that would have been eliminated from your AGI calculation would be tax exempt interest. That has to be
Right.
brought back into the picture.
Right. And it's easy to see what they are.
Next
I'll
slide.
show you on the next page. Okay, when you want to determine what actually goes back into your adjusted gross income to determine your modified adjusted gross income, when you look at your tax return, it's all your tax credits below the top section of your tax return. 50% of your Social Security benefits. This is where most people get caught. They're looking to stay under the limit that you can earn before benefits get taxed, not realizing that 50% of your Social Security benefits are included in that calculation. You got tax exempt interest, half of your self-employment tax, student loan interest, tuition and fees deduction, and qualified tuition expensive, passive income loss, and rental losses, your IRA contributions, unless of course they're a Roth, exclusion for income for U.S. savings bonds, exclusion for adoption expenses. So any tax credit you got before you get to your AGI, it's pretty much getting added back in to determine how much of your Social Security benefits are going to be taxed. So here's when they determine your tax liability for singles less than 25,000. None of that under 25,000 is affecting the taxation of your Social Security benefits. But as soon as you hit 25,000 to 34,000, you're going to be taxed on up to 50% of your modified AGI in excess of that 25,000. Married filing jointly, it's less than 32,000. Once again, that 32,000 is not going to count whatsoever. Once you go over to 32 up to 44,000, 50% of your benefit income or modified AGI in excess of that 32,000 is going to be subject to tax. And then more than 44,000, that's where you're going to go up to 85% of your benefits will be subject to tax.
Now, have
So
they
it can wind up being a pretty hefty tax on your Social Security benefits.
They have not, Sharon, they have not changed these ranges for a long time. Am I correct?
Since 1983, the good news is AMAC is supporting a bill to get these income limits at least increased.
Yeah.
So because back in 1983, 25,000 was probably a decent income.
Mhm.
From what I remember of 1983, because everything was so much cheaper. Now, 25,000, even lower income earners usually make that much a year. So when you got seniors out there working to supplement their Social Security benefits, it can be pretty harsh. But AMAC is supporting a bill to get those hopefully increased.
Yeah, historically, when the taxation of Social Security benefits was enacted into law, it was anticipated it would affect less than 10% of Social Security beneficiaries. The problem now is that because those limits, those thresholds were not indexed, it now affects more than 50% of all filers. And, 44,000 as a married couple filing Social Security, filing their income tax return with Social Security benefits and other income, it's very easy to see how it can be more than 50% of the people affected.
Yeah, especially once you was at 72 now, you have to take those mandatory withdrawals, whether you want to or not, and that pushes most seniors into tax disability on their social security benefits. Now, now paying your taxes on your social security out of your social security benefits is not mandatory. It's optional. You can allow for them on your annual tax returns. But if you should decide, it would be easier on you to have them withheld out of your payment. There is a form called W-4V that you can fill out and submit to your local social security office. It is an IRS form, but it does not go to the IRS. It goes to your local office.
Okay.
One of the questions I know that I get quite often is what rate is Social Security benefits taxed at? And of course, the answer is that it's taxed at the same rate that everything else, if you're in whatever your IRS tax rate is.
Yeah, it's taxed at your personal tax rate.
Some thought that it was like a special tax rate, but it's not. It's the same rate that you pay everything else for.
Yeah, it's basically considered ordinary income for tax rate purposes.
Right. Some people are actually scared they're going to get taxed dollar for dollar.
Right.
Yeah.
And it's like, no, it's your personal tax rate. So if your personal tax rate's 12%, that's what you're going to be taxed at.
Yeah, and you do get a whopping 15% of your benefit that's tax-free.
Yeah,
And,
at that level, the high level, you get 15%. Yeah.
Well, that was added in 1993. It was originally at 50% in 1983, the first time Social Security was in trouble and facing insolvency. And they figured, well, we never paid taxes on 50% of our benefit. And that didn't go over too bad from what they say, because people were like, well, our employer paid 50%. Now we're paying on 50% that we didn't pay taxes. Well, in 1993, they decided to increase it to 85%.
Yeah. Yeah, and as I said earlier, it's a very unpleasant surprise for a lot of people that weren't aware that this was going to happen, and they file their income tax return the first time around after they retired, and then the light bulbs come on, and it's a very unpleasant situation. So
We've had
a lot of
few
seniors
people
owing taxes.
requested AMAC to do something about taxes, and I think they are working on it.
yeah, HR 3971 was introduced in the last Congress, didn't get anywhere. It's going to be reintroduced in the new Congress, and AMAC is supporting it, actively supporting it, because we do get a lot of feedback from, we at the foundation get a lot of feedback from people just calling to say what's up with this taxation, but AMAC itself gets a lot of inquiries from people like, why don't you do something about this? Help us eliminate this problem. So AMAC is actively supporting this bill, and it's got 34 co-sponsors on the bill. So again, I think the odds of it being enacted are slim at best. Unless it's baked into an overall Social Security reform,
Correct.
which is going to get some traction this year, we think, because they've been kicking the can down the road for decades now, because Social Security is in trouble. It has a solvency issue, and
Depends who you talk to, how soon it will be insolvent.
well, current projections are officially by 2034, the trust funds will run out of funding. Although we happen to think it's going to happen sooner than that, with basically the results of unemployment caused by the pandemic and so forth. We think we've seen reports actually that say the trust funds will be fully depleted by 2029, which, if you look at your calendar, is not that far away.
Only 8 years.
And so the longer the Congress waits to enact reform measures, the more punitive it's going to end up being. So we are actively following that. In fact, AMAC itself has a Social Security guarantee plan that would resolve the solvency issue without raising taxes, and we're pushing that actively. AMAC is pushing that actively in the Congress. So, but I think it's going to get a lot of traction in the new Congress.
I hope so. So
We
Okay.
also go as working seniors.
Yeah.
You speak for yourself. So,
Okay, moving into lump sum death benefit.
yeah, the other side of taxes, death. So, the lump sum death benefit, it's a check usually for $255. It's payable to the surviving spouse or child. It's usually paid to the surviving spouse that's living in the same household as the worker when they died. If they're living apart, it's a little bit more complicated, but if, the month the worker died, they were already receiving benefits on the worker's record, or they became eligible for benefits upon the worker's death. Now, if there's no eligible surviving spouse, the lump sum can be paid to the worker's child or children, but if during the month the worker died, they were already receiving benefits on the worker's record, or they became eligible upon the worker's death. So,
And when they say children, they mean children. We get a lot of adult children calling in wanting to claim it, and they mean children,
yeah.
kids.
Yeah, and incidentally, that amount, the $255, is another example of something that was not indexed for inflation, and it's been that forever.
I think it's like the 1950s. I
Yeah.
don't remember it.
Yeah, and just like it grew to that point, because it was growing with inflation, because it started out like $50. And then it just stopped, and they just never took it off the books.
Yeah.
Yeah, because really isn't.
It was at one point a funeral benefit. Now it's just.
Yeah, there was a point in time when $255 was, a lot of money.
Yeah.
That time is long gone.
Yeah,
That
actually,
was many years ago.
the cost of opening a grave. Okay.
Okay, so that's the detail on the lump sum death benefit.
Now, another thing we get some questions about is receiving Social Security abroad. So a lot of people are moving for whatever reason offshore. And when we say abroad, it's not, Puerto Rico, Guam, as a list of, the different United States territories. When we define abroad means abroad, outside of the U.S. and U.S. territories. But you have to note that you must be a U.S. citizen, you must be eligible for benefits, and you must live where United States Social Security can send payments. Not every country will, if you live in a country that we will not send, or I should say, Social Security will not send benefits payments to. And on the next slide, you'll see a list. And also another thing is they do not adjust for international exchange rates. So if you get $500, you say, let's say, oh yeah, money will go further in, I don't know, Costa Rica. Let's say, I'm just picking it off the top of my head, guys. And oh yeah, they'll change it for a cost. No, they will not. Your $500 will be your $500, and then you'll have to do your, exchange rate from there. So, as we said, they will not make payments to a person residing in Cuba or North Korea, and in other countries they won't send the payments. Also, there's a list of countries right there.
There's actually a pretty neat tool on that Social Security has. It's called the Payments Abroad tool, and you can go on the Social Security website and use that tool. You answer a few questions about what kind of benefits you're receiving and where you're planning to go and what citizen you're a country of, and it tells you whether or not you're eligible to receive benefits and in that country, because it does vary a little bit depending on the type of benefit that you're receiving.
So, Medicare and the whole harmless provision. That's not your area.
That's all you, Eileen.
Thanks.
Russ is moving.
Everyone's like moving away from it.
Russ is moving out of arm's length.
Okay, Social Security benefits cannot be, that's called the hold harmless, which a lot of people get confused with. It is your Social Security benefit cannot be decreased due to the increase in your Medicare Part B premium. So your Medicare Part B premiums must be automatically deducted from your Social Security benefit payments. Now, there are basically like 5 groups that are not protected by hold harmless. So you have the new Medicare beneficiaries, you have the higher income beneficiaries, you have those beneficiaries whose Part B is paid by the state, usually through the Medicare Share program. So let's say you're dual eligible. You have Medicare and Medicaid. You're not going to be subject to basically hold harmless. The Part B will be picked up by the state, and they will pay the going rate of the Medicare Part B premium. And then if you pay for premiums directly, meaning you chose to Medicare, but you chose not to get your Social Security benefits yet, you will not be covered under the hold harmless provision. And the fifth one is if you switch from one Social Security benefit to another. That means, let's say you go from, Shannon, example, disability to
application to your own higher benefit.
Yeah.
At that time, if you're not paying the full premium,
Yeah.
you're going to be charged the full premium when your benefit increases.
Correct. So that you fall out of that hold harmless provision. And just for a little FYI type of deal, this year's calculation of Medicare is a little different than the normal Medicaid methodology. What they did, under the Continuing Appropriation Act of 2021 and the other extension acts of they changed the methodology for determining Medicare premiums. They took the 2021 rate must be based on the 2020 rate plus 25% of the difference between the 2020 rate and the preliminary 2021 rate as determined by CMS. And I'll say that fast. So basically, the premium went from $440.60 to $148.50. It should have gone to $160.20. So because there was a lot of screaming, because Medicare jumped up and COLA wasn't going to be low, they decided to use this factor. And that saved a lot of people this year. However, as many things with this, you'll end up paying down the road. So that's just an FYI type of deal.
Yeah,
So
Medicare has only actually gone down once.
Yes.
But the premium actually went down.
Yeah. So in this whole history, that's once. So.
Yeah, and the Medicare trust funds are in worse shape than the Social Security trust funds. So.
Yeah, they're saying anywhere from 2024 to 2026, the Part A trust fund, which pays your hospital, your hospice, and all that. That's the one that's gonna be insolvent within a matter
out
of
of their paycheck.
Yeah, that's the one that comes out of your paycheck, and that is the one that pays your big hospital bills. And that one is going to be basically insolvent by worst case scenario, insolvent by, the best case scenario, insolvent by 2026. But what happens is Medicare will pay those providers at 85%. So as long as people are paying, just like Social Security, it's a pay-as-you-go type of deal. As more people pay into their Medicare, it builds up their trust fund. So, and like Social Security, as more people working, it builds up the Social Security trust fund as well. So let's talk about income-related monthly adjustment amount, IRMAA. IRMAA applies to Medicare beneficiaries with higher annual earnings. Now, just for interest, because you know I do this stuff, IRMAA was first enacted in 2003, but effective on 2007. So it affects about 5% of the population. And then the Affordable Care Act imposed a high income surcharge on Part D. See, at once it only was on Part B, because the Affordable Care Act made it enforced on Part D in 2011. So that's just a bit of history for you. So as you can see, that, like I said, it affects less than 5% of the people with Medicare. And you can see where your premiums are, your $148.50, and then as it goes up, your Medicare, as your income goes up. Next slide, please. And you can see your filing status and how it applies. So if your Individual 88,000 or less, you're going to pay the standard 148.50 for this year. And if you're file jointly tax return, it's 176,000 or less, and it's 148.50. So, now a lot of things we didn't do this slide, which I probably should have put it in, is something we get a lot of. Actually, I have three telephone calls that I have to return on this subject alone is Irma. So they feel they were hit Irma incorrectly. And what happens is you can request a new initial determination if you experience a life-changing event. Let's say a death of a spouse, divorce, involuntary loss of income-producing property. Now, I say involuntary. This doesn't mean that you sold it. It's because you lost it during a national disaster or fraud or something that way. Loss of a pension. Let's say this year we saw a lot of companies, or I should say 2020 saw a lot of companies go out of business, especially a lot of small companies go out of business. They might have lost their pension during that part. So they might have been collecting, maybe they were collecting a very good pension, the company went out, the pension fund went under, and they lost the pension. It's also same thing, the receipt, the employer goes out of business, they declare bankruptcy, and you get a settlement for your pension. Some people get a settlement. You filed an amended tax return with the IRS. Now, you must show proof that the IRS has accepted the amended return, and they call it transcript. They call it tax, amended tax transcript. Correct, Sharon? Because I had to get Sharon's, because I didn't know the terminology, because I
Well,
always
they call it an
tax return.
amended tax return, or they call it a transcript.
Yeah. So they say, if you call up and say, well, you have to send us you have to send a transcript, the approved transcript by the IRS, and you're like scratching your head, and it's like, what's that? And that's what they mean. And
You should get a letter on an amended tax return.
yeah, most of the time, if you did your taxes yourself, you realize you made a mistake 2 years ago, which we have had, that's, a lot of times, you'll get a letter, you file in your amended tax return, you get a letter back from the IRS saying, yes, we accept it. And that will also prove to Social Security that they accepted theirs. And, or if you have recent tax return shows you are receiving a lower than previously reported income. So you can ask for a request for initial determination on that. And then if they turn it down, there's a whole appeals process that's long. So once you get and if you get a letter, please, please, I cannot stress this any much. I don't even know the words to it. I cannot express this more forcefully. Read the letter. Don't ignore it. Read it. Read it thoroughly. It will tell you if you disagree. It will give you the appeal process. The appeals process is a time-sensitive process. You have to follow the time sensitivity. If you wait, let's say, 6 months ago. Oh, I got this letter 6 months ago. And you opened it and you go, I don't agree with it. You have 60 days, not 6 months. So that's my spiel. That's
And
it.
in the case of qualifying,
I am like, mostly tell people, read those letters. Do not wait till the last minute to do stuff because you're going to get yourself caught. So I could cut you off, Sharon. Go ahead.
in the case of a qualifying event, the good news is you'll normally get those extra premiums you paid for a while refunded to you.
Yeah. But just, don't wait. Don't sit on it. So that's the end of my spiel.
Okay, and that's also the end of our workshop today. So that brings us to the conclusion of part 4. And again, I want to thank you for attending with us and absorbing all this incredible information. And as I've said early and in other sessions, the recordings of these sessions are available on our website. And I have sent all the slides to all of you that have attended. If you need copies of them, again, just send us an email and we'll get them to you. But The recordings are available on amacfoundation.org/audio. And just click on the Social Security button and you'll see them. Now the recording for today will not be up until probably Friday or perhaps Monday. We have to get them edited and then reformatted for posting on the website. So they will be up within a couple of days. So with that, I'll say thank you to
Thank you.
Sharon and Eileen and our guest today, Russ.
Thank you. Thank you very much.
Again, feel free to contact us with any questions you have about Social Security. We'd be happy to work with you on them. And you can telephone us at 888-750-2622 or email us at ssadvisor@amacfoundation.org. Our advisory service has 6 accredited advisors available to help you navigate this information. We know it can be very complex, and particularly for people that are just aging into Social Security, it can look overwhelming, and you want to be sure you make the right decision. So that's why we're here to help. So with that, we'll conclude. And again, thank you very much.